and welcome one and all to our presentation today on reasonable comp for S Corp owners. I will promise everyone attending today just a couple of things. First, you will come away with a thorough understanding of reasonable compensation for an S Corp in today's climate. And second, how to take the guesswork out of determining reasonable compensation and create a defensible position should your client's reasonable comp be challenged. An additional housekeeping item for you real quick, your GoToWebinar panel has a little section called Handouts. In there you will find the course outline, and it contains some additional information and links for some of the material we're looking at today, and it follows along with the PowerPoint slides. In addition, the slides are in there, as well as an overview sheet on RC reports, including our promo for today, and a reasonable compensation report sample. Please take a minute and download those. A little bit more about who we are at RC Reports. We're a software firm that determines reasonable compensation for small business owners. We've been around about 5 years. Last year we released version 3.3 toward the end of the year, and we received an Accounting Today Top New Products. So we're very honored for that, and we have somewhere in the neighborhood of 2,500 to 3,000 firms using our software to help them help their clients accurately determine reasonable compensation. Which is the next point. Our software is a tool for CPAs, EAs, tax and financial advisors to use when you need to determine reasonable compensation for a client. We strongly discourage its use from small business owners directly because knowing a reasonable compensation figure is only half the equation. Putting it in the context of the tax or business situation, it's what they need you for. It's what they need their trusted advisor for. It was built around IRS criteria, guidelines, and court rulings. It will deliver an unbiased reasonable compensation figure, and that's key. To be defensible and acceptable to the IRS and defendable in court. We've had very, very good responses anytime it's been used in those situations. Curious about that? Pop over to our homepage, rcreports.com, take a look at the feedback. I'm Paul Hammond. I'm president of RC Reports, and my expertise is in reasonable compensation for small business owners. Also joining us today is Jack Selesky. Jack's our VP of Education, and he is an expert on how reasonable compensation applies to tax, business, and valuation issues. Jack is manning the Q&A panel. So as we go along today, feel free to type in your questions. He'll take a look at them and get back to you. If we're coming up on the information, he'll just ask you to hold tight, but it will make it a very interactive session. Keep one eye on the Q&A panel, one eye on the PowerPoint, and I think you'll pull a lot out of today's course. Our agenda for today. We're going to take a look at the advantage of distribution over wages for most S Corp owners, explore reasonable compensation in the courts, going to go through the IRS guidelines and criteria for determining reasonable comp. We're going to go over profitability of an S Corp versus distributions of an S Corp and its effects on reasonable compensation. This is where most of the questions and confusion on the topic come up. Hopefully we can answer a lot of those questions. We're going to explore what's been going on with the IRS, past, present, and what the future may hold. Take a look at 3 commonly accepted methods for determining reasonable compensation. Share with you some tips from the experts. And then we're going to turn it over to Jack for some Q&A. He'll talk a little bit more about what he's seeing today and some of the most common questions we get in here at RC Reports. I start the presentation with this slide because it is my job today to shift your thinking on reasonable compensation from last century's conventional wisdom to today's rules, guidelines, and best practices for researching and documenting reasonable compensation. Those of you that were in practice prior to 2005 may recall common advice of the day when talking with your clients about reasonable compensation, if you talk to them about it all, right? Revolved around rules of thumb or other artificial safe harbors. Those days are long gone, and it all started with this study in 2005. But it really wasn't until about 2010 when some major reports came out, and we'll take a look at those later, some big court cases came out, that the IRS crackdown on reasonable compensation had really started to come to the forefront, and practitioners and S Corp owners began to take notice. So I'm going to begin by telling you a brief story, and this story will have themes and parallels in the IRS information we're going to look at today and most of the court cases. And the stories always start out with an S Corp owner who's had their reasonable compensation figure challenged. In this case, it was an S Corp owner out of Oklahoma, and they had guessed at their reasonable compensation figure. They had pulled a number out of thin air of $24,000 a year, but they had taken out substantially more in distribution. So the IRS challenged that figure over a 3-year period, 2009, 2010, and 2011, and they adjusted the reasonable compensation figure to right around $100,000. So a couple themes we're seeing already. One, guessing at the figure. The second, when the IRS adjusts the figure, we see it commonly adjusted to somewhere near the Social Security maximum. Well, the S Corp owner got a hold of Tom Shadegg. He's a CPA out of Oklahoma, one of our users. And Tom ran reasonable compensation reports for those 3 years for his client. Now, the reports did not support a reasonable compensation figure of $24,000, but it did support a figure substantially lower than $100,000. Tom shared them with the IRS examiner. They were able to compromise and work out a figure based on the reports. Long story short, the reasonable compensation figure ended up being $60,000 a year rather than $100,000, and that saved Tom's new client roughly, let's see here, Social Security and Medicare on $40,000 a year over a 3-year period, so 15.5% on $120,000. The themes that will follow in the court cases and the IRS information we're going to be looking at are don't guess at a reasonable compensation figure. In a recharacterization, we often see the IRS propose a figure right around the Social Security maximum, but not always. We've actually seen it go higher. And that research and documentation that's unbiased are critical for supporting a reasonable compensation figure. As we get going today, I just want to talk briefly about some terms, more accurately some interchangeable terms. When you're thinking about reasonable compensation, it can be very helpful if you think about it as either replacement cost or fair market value. In other words, as an S Corp owner, if I had to bring somebody into my firm to provide all the services I'm currently providing, what would that cost me? That's replacement cost. And then the second is fair market value. As an S Corp owner, if I were to take all the services I'm currently providing to my S Corp out into my community, what would my community pay me for those same services? It's a simpler way for us to think about it, but it's also a much easier way to explain it to our clients. We're looking at a lot of information from the IRS and the courts, and we'll sometimes see distributions referred to as dividends, sometimes again as loan repayments or returns of basis. You see those terms, just think distribution. And finally, shareholder employees are sometimes referred to as corporate officers, as S Corp owners. I sometimes refer to them as small business owners. You see or hear any of those terms, just think shareholder-employee. Also throughout today's webinar, these little icons will pop up from time to time. The little red ones are going to bring your attention to what we're talking about. And a little later in the webinar, when the green ones pop up, it'll tie that concept together with what we're talking about there. And hopefully you can make that connection. Let's dive into our first topic for today. And that is going to be the advantages of distribution over wages for most S Corp owners. S Corp shareholders will generally prefer distributions of their S Corp profits over wages because wages are subject to payroll taxes and distributions are not. So to prevent S Corps and their shareholders from avoiding payroll taxes by maximizing distributions and minimizing salary, the IRS requires S Corps to pay shareholders who provide substantial services reasonable compensation. So for now, I don't want you to get hung up on the word substantial. We'll talk about that a little later. I just want you thinking that an S Corp owner who provides services needs to be paid reasonable compensation for those services. I'm going to take us through two basic examples so we make sure we understand what that advantage looks like. And my test subject for today is Scott Stone, and he is 100% owner of Stone Concrete. His business is concrete flat work, sidewalks, patios, driveways, etc. He's a full-time employee of his company, and he has 6 others that work for him. In this example, we're going to have Stone Concrete generate $100,000 of net income before we consider Scott's salary. In example number 1, I'm going to have Scott take that entire $100,000 out of salary as reasonable comp. That'll drop Stone Concrete's taxable income to 0. That $100,000 of wages will find its way to Scott's 1040 via a W-2. So in this example, both Scott and Stone Concrete are responsible for payroll taxes. Stone Concrete's piece will be $76.50. Scott's will be the same. Also in here is state and federal unemployment tax. Now, I don't have a figure in here because it varies by industry and region, but it is part of the overall payroll liability. Payroll liability in this example is going to be greater than $15,300. It'll probably be north of $16,000 by the time we factor in FUTA and SUTA. In the next example, we're going to start with the same assumptions. Except in this example, I want Scott to take the entire $100,000 out as a distribution. Now that $100,000 is going to find its way to Scott's 1040 via an 1120S. And in this example, neither Scott or Stone Concrete owe any payroll taxes. Obviously, that's on Scott. Stone Concrete will owe them on the other employees. Because distributions are not subject to self-employment tax, Scott won't owe any self-employment tax on that distribution. If Scott has the ability to classify that distribution as a return of basis, we'll do an extreme example here, he won't owe any income tax on that $100,000. Total tax liability in this example is 0, and that's going to save Scott and his company north of $16,000 with FUTA and SUTA factored in. Therefore, there is a tremendous motivation for shareholder employees to minimize their salary in favor of distributions. However, the IRS requires any shareholder of an S Corp who performs services to pay themselves reasonable compensation, and that requirement reads as follows. Distributions and other payments by an S Corp to a corporate officer must be treated as wages to the extent the amounts are reasonable compensation for services rendered to the corporation. So one of the more important court rulings, which is commonly referred to as Watson, supports the IRS's position on reasonable compensation, and more importantly, its authority to recharacterize distributions as salary. Our next topic is reasonable compensation in the courts. And most of the information and guidance that we rely on to help us determine reasonable compensation comes to us through the courts. To date, there have been in the neighborhood of 25 or 26 cases, and the IRS has prevailed in all but one of them. In the one the IRS lost, the courts actually determined that the shareholder was not a shareholder-employee, just a shareholder. And I'd also argue they didn't lose that case as much as they didn't win it, and it's the only case we're going to look at today that came out prior to 2005. It helps us understand substantial services, and it's got some very other good information in there for consulting with your clients. So we're going to begin right now by looking at 2 court cases. The first one's going to be Watson, and then a little later we're going to look at a couple more cases when we get into a little bit more advanced scenarios. We're going to begin with the case most of you heard a lot about, commonly known as Watson. This case is important because the majority of IRS guidelines, criteria, fact sheet 2008, these all came out while the Watson case was working its way through the courts. It came out post-2005 when the IRS shifted its strategy and enforcement on the topic of reasonable compensation. And so the Watson case revolved around Mr. Watson's low pay as a shareholder employee of his S Corp. According to the decision, Mr. Watson's firm made profit distributions of over $203,000 in 2002 and over $175,000 in 2003 to Mr. Watson through his S Corp. Each of those same years, Mr. Watson paid himself only $24,000 in salary, $24,000 in reasonable compensation. And so the IRS objected. They said, hey, that $24,000 isn't enough for somebody who has a graduate degree in tax, 20 years of experience, and worked full-time for his firm. So in 2007, the IRS audited Mr. Watson. And they calculated his reasonable compensation to be just over $91,000 for 2002 and the same for 2003. The IRS then went in and recharacterized just over $67,000 of dividends and loan payments as wages for each year, and that totaled just over $134,000. Total tax penalty and interest assessed to Mr. Watson was just over $48,500, and that's more than double the original tax that would have been owed on that amount of just under $20,000. And that's a pretty common scenario. If you have a recharacterization take place, by the time you factor in the taxes, the penalty, and the interest, you can usually just over double what the original tax that would have been owed would be. Well, Mr. Watson did not agree with the IRS's right, this is a key point on this case, the IRS's right to reclassify his distributions as wages. So he took that IRS ruling to court. And in December of 2010, the U.S. District Court for the Southern District of Iowa ruled in favor of the IRS. This is also about the time another major report came out, and it's about the time that small business owners and their advisors started to hear rumblings about what should we be paying ourselves as reasonable comp. So let's take a look at a little bit of information from the court ruling. First off, the court agreed with the IRS's initial objections. His graduate degree, his education, his experience, and his full-time dedication to the firm. They also looked at all the job duties Mr. Watson performed. He was a CPA, managing partner, also did some very specialized business planning. But for my money, there's two key points of this case, and this is the second key point. The first is the IRS's right to do that recharacterization. The second, and the court pointed this out, Mr. Watson had no research and no documentation to back up the $24,000 figure. Well, Mr. Watson, not ready to give up, appealed. And in February of 2012, the U.S. Court of Appeals for the Eighth Circuit upheld the district court's ruling. And this reconfirmed, and put a giant exclamation point on the IRS's right to reclassify distributions as compensation if they believe the shareholder-employee of the S Corp did not pay themselves reasonable compensation for the services they provided. Those of you keeping score, Mr. Watson did appeal to the Supreme Court, but the appeal was denied. So a couple of important factors from the Watson case. One, it cemented the IRS's right to reclassify distributions as wages. And second, for the first time, because prior to 2005, most of the court cases, if not, I think almost all of them, maybe one, except for one, they revolved around zero reasonable compensation, zero wages versus large distributions. And then the recharacterization was also an all or nothing scenario where they recharacterized the whole distribution. Now, post-2005, we see the IRS take a taxpayer to court, even though he had paid himself some amount, given it was only $24,000. But then we also see an attempt to come up with a reasonable compensation figure for Mr. Watson, $91,000. So this case didn't do a great job in giving us direction on how they came up with the $91,000, but the next case we're going to look at does. Sean McAlry versus Commissioner. Simply refer to it as McAlry. I'm going to give you a little background. McAlry Limited was a real estate company owned by Sean McAlry. He worked full-time for the firm and had some other agents working for him. And in 2006, his company had a net income of over $230,000. Mr. McAlry took a distribution of $240,000 and paid himself zero salary. So we're not looking at this case to see why Mr. McAlry caught the attention of the IRS. However, this is a very good way to do so. We're looking at it because we have three parties who weigh in on what Mr. McAlry's reasonable compensation figure should be, and we're going to start with the IRS. So the IRS expert in this case said that Mr. McAlry's reasonable compensation figure should be right around $100,000, $100,755. At the time, that's pretty close to the Social Security maximum, as was Mr. Watson's back in, was it 02, 03, the time frame he was examined. So in support of this figure, the expert cited his primary job function as a real estate broker, his full-time dedication to the firm, and they also compared McAlry Limited's performance with its peers in the real estate industry, and that will map back to a specific type of method for determining reasonable compensation called market that we'll talk about a little later. Also, in presenting the case, the IRS gave us our two definitions of reasonable compensation, stating that McAlry Limited could expect to pay $48.44 an hour to another individual in exchange for the services Mr. McAlry performed. That's our definition of replacement cost, and they went ahead and gave us fair market value too, stating that $100,755 would be fair market value of the services Mr. McAlry performed. Those of you that are good with numbers in your head or had a calculator handy, if we know annual is $100,755 and hourly is $48.44, what's the multiplier? It's 2080, and this may be a familiar number to some of you. If it's not, this will be a very good number for you to jot down on a sticky note and keep handy. It is the industry standard for the number of hours worked by a full-time employee year-round. And it's an easy number to get to. Take 40-hour work week, multiply it by 52 weeks a year, and you will get 2080. And it's interesting to note here that the IRS expert in this case used the industry standard, even though Mr. McAlry worked well over 40 hours a week. He was easily in the 60, 70, maybe even 80-hour a week category. So on one side of the room, the IRS says $100,755. On the other side, Mr. McAlry says $24,000. Sorry, I chuckle a little bit when we do this presentation live. We always get some laughs. It's a very popular number. It's the number one reasonable compensation number we see pulled out of thin air. And in Mr. McAlry's defense, he had said that we did make a mistake. Myself and my CPA, there was a miscommunication, there was a mistake, a misunderstanding, whatever the situation was, and I should have paid myself some amount of reasonable compensation. We admit that, but it should only be $24,000. It should only be $24,000 because I have a compensation agreement that spells that out, and you can see it as part of our corporate minutes, meeting minutes. And it even has some increases in it based on the number of agents. And I don't know how you folks like your comedy or your irony, but I love the fact that the board of directors meeting took place on April Fool's Day. So on one side, $100,755, on the other side, $24,000. What does the court finally come up with? They said Mr. McAlry's reasonable compensation should be $83,200. So I like about this case, we get to see some different approaches, including the courts and the IRS's. And so the court, in explaining their number, cited the various services Mr. McAlry performed, which will map back to a type of a method of determining reasonable compensation called replacement cost or many hats. Then they went out and found a wage range. And within that wage range, they selected $40 an hour, multiplied that by the magic 2080, and came up with $83,200. The court, in explaining its decision, they talked about a couple of things that they liked and a couple of things that they did not like from both sides of the aisle. Here's what they didn't like from the McAlary side. They didn't think that compensation agreement was very much help. It wasn't a sound measure of the work he was doing. There was no research and documentation to back it up. It was just simply a number plugged into his corporate minutes. And it was clearly not the product of an arm's length negotiation. And that is generally an issue with most small businesses. There's the officers, shareholders, they're all the same person or people, so an arm's length negotiation generally is just not possible. What they didn't like from the IRS side of the aisle is that industry comparison that's going to map back to the market approach a little later. In this particular case, the court didn't find it helpful comparing McAlary Limited to its peers in the real estate industry. Some of the things they did like, they looked at the various services. They also looked at his experience. Mr. McAlary was fairly new to the real estate game. They went out and found a wage range. On the low end, it was around $33 an hour. On the high end, it was just over $64 an hour. Within that wage range, they picked $40 an hour, multiplied it out, and that's how they came up with 2080. But a key piece from this case that I really like came from the court stating that determining an employee's reasonable compensation is dependent upon a number of factors and is far from an exact science. That's where your research and documentation becomes critically important, having a roadmap to show whoever is asking how you get to your reasonable compensation figure. So the wage range they used, COESS, that is the California Occupational Employment Statistics Survey, and it is an annual report that's produced jointly by the U.S. Department of Labor and the California Department of Labor, for those of you that are curious. So let's move into the IRS criteria and guidelines for determining reasonable compensation. And I find the best place to start here is with the definition. The IRS defines reasonable compensation as the value that would ordinarily be paid for like enterprises under like circumstances. If you want it directly out of the code, it reads, the amount of compensation must be both reasonable and payments must be, in fact, for services rendered. Or we can just keep in mind that we can be thinking about it as either replacement cost or fair market value. When a business elects to be treated as an S Corp, the IRS will send out this acceptance. And the IRS has two main tools in their tool belt to help gain compliance on reasonable compensation. One is information and education, and then the other one is examination. And this is information and education. And this is the IRS's way of letting the shiny new S Corp know from day one about the issue of reasonable compensation. They're going to take the opportunity to inform you of your obligations as it relates to compensation to shareholder employees of S Corps, and that when a shareholder employee provides services, reasonable compensation generally needs to be paid and is subject to employment taxes. The next paragraph will let you know that they have the right, and Watson cemented this, to recharacterize distributions as wages if they were paid in lieu of reasonable compensation. I'm also going to point out here that the IRS calls out small businesses. The overwhelming majority of S Corps are small businesses. And as we move into looking at the criteria, guidelines, and some of the court cases we look at, keep in mind we're talking mainly about small businesses. So then the question usually pops in your head, what is a small business? Well, that's a good question because it really depends on who you ask. But businesses are generally considered small if they have under 10 million in assets, that's an IRS definition, or under 7.5 million in revenue or under 250 employees, and that's a small business administration definition. The IRS guidelines for determining reasonable compensation start out by stating, the key to establishing reasonable compensation is to determine what the shareholder-employee did for the S Corp. As such, we need to look to the source of the gross receipts, and they outline 3 of them. First is services of non-shareholder employees, second is capital and equipment, and then third is services of the shareholder. So we're going to begin by taking a look at services of non-shareholder employees and/or capital and equipment. If the gross receipts and profits come from services of non-shareholder employees and/or capital and equipment, then that should not be associated with the shareholder employee's personal services and not be allocated as compensation. Well, that makes sense. That's fairly intuitive. On the other hand, if gross receipts and profits are associated with the shareholder's personal services, then reasonable compensation needs to be paid for the services provided. And that brings us to services of the shareholder. So the guidelines go on to state that in addition to the shareholder employee's direct generation of gross receipts, the shareholder employee should also be compensated for administrative work performed for the other income-producing employees or assets. We met Scott Stone a little earlier in the webinar. When Scott's determining his reasonable compensation, he needs to make sure he's including the time he's out in the field finishing concrete and the administrative tasks he performs, bookkeeping back in the office or running estimates in the evenings. He needs to make sure he pays himself for all the services he's providing for his company. So post-2005, the IRS releases fact sheet in 2008, and it's fact sheet 2008-25. And this produced a much-needed framework or roadmap that shareholder employees and their advisors can use to help them determine reasonable compensation. It includes some of the information we just looked at, and it also includes 9 factors that the courts may look at when they're trying to determine whether a reasonable compensation figure is fair or not. As you'll see at the bottom, one of them is compensation agreements. This is the one that Mr. McAlry was counting on. However, he didn't take into consideration some of the other points, and he had no research and documentation to back that number up. And when the courts look at a list like this, they may use one of them, 2 of them, all of them, some combination of any of them. Let's go ahead and work through them one at a time. And I would like you to think about the 9 factors more as a stress test of a number. So the first one is training and experience, and we're going to stress test this against Mr. Watson. Mr. Watson had a graduate degree in tax and 20 years of experience. Does $24,000 seem like enough salary, enough reasonable compensation? Probably not, but we don't have enough information yet to decide. Number 2 is duties and responsibilities. Mr. Watson was a CPA, managing partner, did some specialized business planning. Does that seem like $24,000 seem like enough? Again, probably not. And 1, 2, and 3 on this list are your 3 major stress tests. And then you take a look at 1, 2, and 3, and you combine it with the third one, which is time and effort devoted to the business. Mr. Watson worked full-time for his firm. $24,000 seem like enough? No. Nope, it's not, and that's why his reasonable compensation figure was adjusted up to right around $91,000. However, let's say Mr. Watson only worked 10 hours a week. Well, all of a sudden, $24,000 is pretty much spot on. It's about a quarter of the number they gave him for full-time employment. Almost all reasonable compensation calculations are based on comparability data. So number 4 is what comparable businesses pay for similar services. If we look at Watson again, college graduates who were entering the accounting field back in 02, 03 were receiving salaries significantly higher than what Mr. Watson was paying himself. The use of a formula to determine reasonable compensation. I want you to think about this as your research and documentation. Draw a roadmap. How did you get your reasonable compensation figure. Where did you get your data? What assumptions did you make, etc. Number 6, payments to non-shareholder employees. This is more of an internal check within the business. So we use Scott as an example in this one, Scott Stone. If he's paying himself $10 an hour to finish concrete, however, he's paying his employees $20 an hour to finish concrete, that's going to be an issue. So you also have to have some internal consistency as well. Number 7 is compensation agreements. This is the one Mr. McAllery was counting on. This is the least helpful of the 9 factors, in my opinion, for the same reason it didn't help Mr. McAllery. The shareholders, directors, officers, they're generally the same person or people, and putting that arm's length negotiation into place is just not practical. However, and we'll see this once or twice more before the end of the presentation, adding your research and documentation for your reasonable compensation figure into your corporate minutes is a very good practice. It's a very good extra step. It will give your reasonable compensation figure an added layer of defensibility. And this is from a 30-plus year veteran of the IRS who gave us that tip. So number 8 and number 9, we're going to break into their own section. It gets into a little bit of advanced scenarios and information. It's where a lot of the questions come up. But number 8 refers to a number of different catch-all categories. And some of this is throwback to C Corp issues. But timing is going to be referring to look-back periods. Manner of paying refers to the fact that distributions don't always have to be cash. They can be other things of value. And then of bonuses to key people, that's more of, again, an internal check and a timing check. And they dovetail into and usually work hand in hand with dividend history. Our next topic is profitability versus distribution and its effects on reasonable compensation. And reasonable compensation has very little to do with the profit of an S Corp and almost everything to do with the S Corp's distributions. The IRS guidelines for reasonable compensation state, the amount of reasonable compensation will never exceed the amount received by the shareholder, either directly or indirectly. It doesn't mention profit or loss at all, but instead it talks about amounts received by the shareholder. Therefore, we need to focus on the distribution of the S Corp, not the profits. So a lot of questions on this particular topic. Hopefully we'll be able to answer most, if not all of them. And we're going to do it by running through a series of examples. And we're going to start off with a very basic one, and we're just going to ratchet it up a little each time. And we already met Scott Stone earlier. We're going to keep his reasonable compensation figure pretty much the same in all these examples, just under $75,000. In this first example, in 2013, Stone Concrete is going to have a net profit of $190,000, and this is before we consider Scott's salary, Scott's reasonable compensation. Scott consults with his CPA, and he elects to take $160,000 out of Stone Concrete. So how will that happen? Well, we just go back and we look at the IRS guidelines. Scott has to pay himself reasonable compensation for the services he provided before he can take out a distribution. So Scott will receive reasonable comp of $74,685. He can take the remainder out as a distribution. And that's how that $160,000 will exit Stone Concrete. That's the simplest, most basic example that I can share with you. In the next example, in 2014, Stone Concrete doesn't have as good a year. They only have a net profit of $23,000. Scott talks it over with his financial advisor, and he elects to take $30,000 out of Stone Concrete. And that $23,000 is before Scott's salary, obviously. So what do we do in this scenario? We just fall back on the IRS guidelines again. The amount of reasonable compensation will never exceed the amount received by the shareholder, either directly or indirectly. Based on that guideline, Scott will receive wages of $30,000, no distribution, and that's how that $30,000 will exit Stone Concrete. A few things to point out here. Scott doesn't need to come up with $45,000 to put into the company so he can then pay himself his reasonable compensation figure of $75,000. that $75,000 is his replacement cost or his fair market value. The amount he pays himself is going to be tied to the amount of distributions he takes out. Those of you that consult with small businesses, this is also a crossover point when you're talking to them about working for your company as an employee and receiving compensation as an employee, and then going beyond that number, starting to receive distributions and receiving compensation as a business owner. It's a good number to know in general. Now in 2015, Stone Concrete has come storming back to profitability. They had a really good year, $150,000 in net profit before considering Scott's reasonable comp. And Scott sees nothing but potential with his company, and he has huge growth plans and decided not to take out any money from Stone Concrete. So this time, a lot of folks will reach for the keyboard and start lighting up the Q&A panel, but hang in there with us. Before you start asking any questions, we understand that there are ramifications back on Scott's 1040, but please understand it's Scott's decision ultimately how much money he wants to take out of Stone Concrete. So since he's taking no distributions, he'll receive no wages, no distribution, and no money will exit Stone Concrete. A point to make here that the IRS cannot create compensation. It can only recharacterize what was actually paid out. It cannot force a shareholder to take money out of the corporation. So this also should generate some questions about time periods and look-back periods. So our final example, we're going to take a look at a 3-year period with some look-back periods. And we're going to give Scott the same reasonable comp for all 3 years, make it simple. His company has net profits before his reasonable comp of 130, 135, and 145,000 for a grand total of 410. 2013, Scott doesn't want to take any money out. He'll receive no wages and no distribution. In 2014, same scenario. No wages and no distribution. And again, we understand this is impractical for most S Corp owners. However, ultimately, it's Scott's decision. But what happens when we get to 2015? Scott decides he wants to take out as much money as he possibly can. Talks it over with his CPA, his tax advisor, and Scott has elected to take out $400,000. So what happens in this scenario? Well, we just fall back again on the IRS guidelines that state you need to pay yourself reasonable compensation before you can take the distribution. The distribution is over a 3-year period. He'll need to pay himself reasonable compensation for the time he spent working for that 3-year period. He'll pay himself $225,000 in wages and take the remainder out as a distribution. So there appears to be a little bit of a tax planning opportunity here for S Corps that can delay taking distributions because of the Social Security maximum. In this situation, Scott will only be paying Social Security amounts up to 118, is it 118.5, I think? And then he'll be paying the additional Medicare tax above that. So a little bit of a tax planning opportunity. It's not very practical for most S Corp owners, but it appears to exist. So next we're going to move into some additional court cases that talk about a little bit more advanced information, and they all have they also all revolve around the issue of distributions versus profits. And again, a post-2005 case. This one came out in 2013, commonly called glass blocks. When this case hit the press, this was the typical headline that you would read: how an S Corp can lose money and still be required to pay reasonable compensation. And I have this court case in here for a couple of reasons. One, it helps with the distribution question, but it also has a fantastic opportunity for those of you that consult with your S Corp clients in helping them possibly reach some of their goals when it comes to distributions. So let me give you a little bit of background on glass blocks. It was owned by Frederick Blodgett. In 2007, he had a net income of $877. Glass blocks did. He transferred in $45,000 to keep the business afloat. That same year, he transferred out almost $31,000 and paid himself no reasonable compensation. Well, why would he? The company really wasn't profitable. However, we didn't use the word transferred arbitrarily, because that is what this case is going to revolve around. The IRS, in their examination of glass blocks, looked at that money going in and out. We'll call them transfers. And they said that the transfer in was a contribution to capital, additional basis. Therefore, the transfer out was a distribution, a return of basis. The IRS guidelines are very clear that you have to pay yourself reasonable compensation before a distribution can be made. So glass blocks took the opposite position, no surprise. They said, nope, those transfers in were a shareholder loan to glass blocks. Therefore, the transfers out were a repayment of that loan. And we are certainly within our right to pay back our creditors before we pay reasonable compensation. Well, early in the webinar, it's kind of a spoiler alert, since you know the IRS hasn't lost any of these cases, except possibly Davis, depending on your opinion. So glass blocks lost. And the question was around the transfers. And the court decided that the transfers in question were actually capital contributions and not a bona fide loan. And they have a list, kind of a stress test like we looked at for reasonable comp, for this question as well. And they focused in on 4 in this particular case. There was no written agreement or promissory note. There was no interest charged. No security was put up for the loan. And there was no fixed repayment schedule. Didn't look like a loan, didn't act like a loan. It wasn't a loan. In your course handout, there's a longer list of these factors that the court will look at, but these are the 4 they focused in on this case. And they continued on to say that where the expectation of repayment depends solely on the success of the borrower's business, rather than an unconditional obligation to repay, the transaction has the appearance of capital contribution. So this case gives you a very good planning opportunity with your clients. If they would like to get out, let's just call them transfers into the business before paying reasonable compensation, help them properly treat them as a loan. If you do that, you're within your right to pay your creditors before you pay reasonable compensation. But if it's basis, you're going to need to pay reasonable compensation first. So this is how the math worked out. They started out with a net income of $877. They recharacterized the transfer or the basis as wages. He paid employment taxes. That's the business's half, penalty and interest. And that's how you go from profit to loss by being required to pay reasonable compensation, which could have been simply avoided by properly treating those transfers in and out as loans. And our final court case of the day, and the only one we're looking at prior to 1994, is the Davis case. And let me give you a little bit of background here. Carol Davis was one of 2 owners of Mile High Calcium. The other owner was her husband, Henry Adams. It's also a good case because a lot of S Corps are owned by husband and wife, 50-50. Again, it revolves around those pesky transfers in and out, again, a 3-year period, and we see most challenges take place over a 3-year period. Details of this case are a little hard to come by. However, what we do know is that the total tax, penalty, and interest that was assessed to Mile High Calcium was just over $39,000. So Carol, Carol took the IRS to court, and she put on a 2-pronged defense, one for each shareholder. And she began with her husband, Henry Adams, who was listed as the president. By the way, the IRS will normally default if a shareholder has a title, an officer title. They will almost always by default assume that they're providing services to the company. And that's what they did in this case. However, Carol was able to show that Henry Adams was actually not an employee, even though he was an officer. Because he had no active participation, he actually worked for outside companies during this time, and they were able to produce W-2s to support that. Therefore, he was an officer in name only, and there's an exception in the regs. So she won on that. She was able to wipe out half of that recharacterization by addressing Henry Adams as not being a shareholder-employee, just a shareholder. So then they turned their attention to Carol. Now, Carol was an employee. However, she didn't spend much time working in the company. She was able to substantiate that she only worked about 12 hours per month. That's less than 3 hours a week. That's a pretty low bar for substantial services. The type of work she was doing, she was able to show that it was only worth about $8 an hour. They multiplied that figure out, and they did get their taxes, penalty, and interest on that amount of reasonable comp that was recharacterized. But in the big picture, the tax, penalty, and interest went from $39,000 down to $647,000. Takeaway from the Davis case, and this is the closest to figuring out what substantial services mean. It's a pretty low bar of 3 hours per week, but this is how I recommend you think about substantial services. If it's a service that the business requires and needs and it's being done by a shareholder, then they're a shareholder employee and they need to be paid for those services. An example of a service that may not be what we call substantial or necessary. We see a lot of S Corps owned by husband and wife, right? Everybody wants to be part of the business. They also want a title. It's fun. It makes you feel important. But I'll give you an example of an S Corp owned 50-50 by a husband and wife. The husband works in the company full-time and the wife does not, but she is an officer of the company. However, about a half dozen times a year, she comes into the office and she does a luncheon and celebrates birthdays for that time, for that month. Very nice gesture. The company's happy to have it. The employees are happy to have it. However, if it went undone, the company would still function just fine. The employees might not be quite as happy. They didn't get lunch and cake, but it's not what I would consider a substantial service. But if she came in 5 hours a week and helped out with bookkeeping, probably needs to be paid for that service. This is also a very good planning opportunity with your S Corps that have an officer in name only. If a shareholder is an officer in name only, document it, because there's an exception in the Treasury regs who perform no services or only minor services. If an officer does not perform any services or only minor services and is not entitled to compensation, the officer would not be considered an employee. When you're taking on the best practice of researching and documenting a reasonable compensation figure and adding it to the corporate minutes, if you have this situation, go ahead and add it into the corporate minutes as well. It's an easy step and can really save you some headaches should this situation come up in a challenge. And we're going to take a look at what's been going on with reasonable compensation and the IRS, past, present, and what the future may hold. And we are going to begin prior to 2005. The most recent compliance study that the IRS had done on S Corps involved only about 10,000 returns from way back in 1984. Didn't I just make a remake of Ghostbusters? That's dating myself a little bit. Anyway, what we want to do is take a look at some of the things that led up to 2005. Why did the IRS do a new study in 2005? And it was because of reports like this, and there were many of them. I'm going to use one just as an example. And this is a TIGTA report, and that stands for Treasury Inspector General for Tax Administration. The IRS does not always address S Corp officer compensation during examination. And there's 3 important points to pull from this. When TIGTA did a review, the average wages being paid to shareholders, shareholder employees, was $5,300, and the average distributions was $350,000. They made a point and a recommendation that examiners need to determine the level of service provided before an allocation of compensation can be made. And they recommended that the director for the Small Business Self-Employment Division supply guidance, such as software, to their personnel to help them determine reasonable compensation. And this report and many others made these 3 points over and over again. It's a big problem, and examiners need better training and better tools. And one of the things that happens with these reports is recommendations are made, changes are implemented, and then they take another look. So the IRS took note of this report and many like it, and in 2005, they launched a study of S Corp reporting compliances. And this is probably the one that Watson ended up being tangled up in. And then we wait. Over the following years, there's a number of reports that continue to come out, mainly pointing out that it's still a problem, making suggestions, calling for training and tools. But it wasn't until the end of 2009 that a very thorough report that came out, mostly based on that study by the General Accounting, the GAO, the Government Accountability Office, and that was entitled Actions Needed to Address Non-Compliance with S Corp Tax Rules. This is why, even though the world of reasonable comp started to change in 2005, most S Corp owners and their advisors didn't really start to notice until sometime in 2010, 11, and 12. This is a very thorough report. We're only going to look at a couple of the highlights from it. 68% of S Corp returns filed for 03 and 04 misreported at least one line item affecting net income. The overall net misreported amount that was passed through was about $85 billion, and this is probably the most telling number. The GAO did its own calculation, 03 and 04. Net shareholder compensation underreporting was roughly $23.6 billion. In other words, we would like to have Social Security and Medicare paid on $23.6 billion. And as we know, the Social Security and Medicare funds could very well use that revenue. So the GAO put together a table of the most common misreported line items. And by median misreported amount, which is that third column on the right there, it should come as no surprise that shareholder compensation was number one at just over $20,000. It should also come as no surprise that number two on that list at just over $7,400 was distributions. And we just finished talking about the fact that distributions and reasonable compensation are almost always tied to one another. Now, I do not have it printed on this slide, but if you were to take this right-hand column right here and add it up, you're going to come up with just over $50,000. Make a little mental note of that because it'll be relevant here in just a minute. So the TIGDA reports and the GAO reports always come with recommendations. And generally speaking, the IRS accepts the recommendations and starts to implement change. The GAO recommended that they further analyze the problem with non-compliance and identify options for improving it, and improve guidance to their examiners so they may better target and determine adequate shareholder compensation. So this comes out at the end of 2010. The IRS starts to implement change, and then we wait for reports to come out. This is the most current report on the subject of reasonable comp that I've come across, and generally speaking, if anything comes out, I see it. And I say that because it's 2016 now, and we haven't seen another report on this, but I expect we'll see one fairly soon. So this is the TIGDA report. Recommended adjustments from S Corp audits are substantial, and we'll see that in a second. The number of no change audits is a concern. We're now looking at much more current data. We're looking at years 2007 through 2011. Examiners completed 53,500 examinations, recommended 5.7 billion in adjustments. What that means is for each return audited, the examiners are generating $105,000 in adjustments. It's a big number, and that's more than double what we saw just a couple of minutes ago in the GAO report. I said if you add up that right-hand column, it's going to be just over 50,000. So in just a short time frame, they've doubled that recommended adjustment. And this report went on to make a couple of recommendations. The IRS needs to come up with better methods for developing audit leads and algorithms. And although we haven't seen it in a report, we have heard back from some folks that have some information on that they continue to develop more and more sophisticated algorithms to try and find these. And second, that they improve guidance to their examiners so they might better target and determine shareholder compensation. That's training and tools. So the IRS agreed to both of these recommendations, and from the feedback that we get at RC Reports pretty regularly, it seems like a lot of the examiners, not all of them, but a lot of the examiners have had some training on this if they're in the small business division, and they understand the criteria and guidelines and looking for comparability data. So that's the good news. Jack and I get asked regularly about red flags. We don't want to throw a red flag. We don't want to have our reasonable compensation figure challenged. Well, let me first start by saying that if you throw a red flag with the IRS on the issue of reasonable compensation, it doesn't mean you've paid yourself in an unreasonably low amount. It just means for whatever reason you threw a flag with them. But the number one and easiest way we saw in McAlry is zero reasonable compensation versus a large distribution. Second on that list is just a low salary versus a large distribution. And the number one figure we see guessed at is $24,000 followed by $36,000. And I understand where those numbers come from. It just sounds like a reasonable number to a small business owner. I'll pay myself $2,000 a month or $3,000 a month. The Minnesota Society of CPAs, in their red flag list, they put out these 7 mistakes that may trigger an audit from the IRS. And this is for all categories. And number 3 on that list was low salary versus a distribution. Other things that may trigger an IRS red flag, if your ratios are out of line, high sales versus your competition, large distribution versus your compensation, or large profit versus compensation. We know they're used, we don't know what the algorithm looks like, or what will necessarily trigger a reasonable compensation challenge. And again, throwing a red flag doesn't mean you paid yourself unreasonably low. That's where research and documentation come in. Here's what we think you can expect in the coming years on the topic of reasonable compensation. More automated compliance programs. The IRS needs to do more with less. So it may just simply be a letter challenging your reasonable compensation. The pendulum is always swinging one way or the other. And with the IRS, it's no different. For the longest time, they were having their budget cut. For the first time in a long time, they've had it increased, and they are hiring again. This year, they plan on hiring between 600 and 700 new examiners. And Kiplinger, which has been a really good source this year on information, has given us a couple of insights. S Corp audit rates were up 11% from the previous year, and that was came out in their February newsletter. And then just last month, in their enforcement section, they said that the IRS is going to be shifting away from their 1040 field exams and focusing a greater chunk of their resources on pass-through entities where they have a, where the IRS believes it can get more bang for their buck. And finally is preparer penalties. Jack and I end up at a lot of industry events and conferences. And last year, for the first time, we had a couple of CPAs and EAs come up to us and express that they had been hit with preparer penalties. One was just under $5,000, the other one was $5,000. I think it was like $4,950 and then $5,000. We talked to them a little bit about the situation and what it was, and they seemed far, far from egregious. Not anything you would expect a preparer penalty on, but yet they were hit with them. And the IRS's position is that you need to be addressing this with your clients, and if you're skipping over it or not questioning what looks like an unreasonably low number, they began handing out preparer penalties last year. And it's also an attempt, I think, and this is actually an opinion of and I can't remember who was talking about this. It's also a form of getting CPAs and EAs to be more of the IRS watchdogs. If you know that you have some skin in the game, you may act more of a policeman and help get clients and S Corp owners on target with reasonable comp. Let's talk about you folks for a little bit, those of you that do tax prep, whether you're a CPA, an EA. When a reasonable compensation challenge happens, especially if you haven't talked with it about your client, they're going to be, hey, what's going on with this? And, you know, since we didn't talk about this, we're going to be looking to you to pay the penalties and interest. And by the way, all those returns that need to be done, we don't want to pay for those either. Sound familiar? And something we hear over and over again. And of course, you always have the risk of a malpractice claim. Now, most tax preparers don't think too much about, bring that slide back up, about the malpractice claim because they're thinking about penalties and interest on a reasonable compensation challenge. But I am going to throw out two scenarios where it can be a bigger issue. One is with multiple shareholders. If there is a recharacterization and the recharacterization causes the distribution to become unequal, now you have an unequal distribution and that can cause a involuntary revocation of the S Corp. And that is usually financial disaster for the small business. When you're looking at your client list and thinking about, well, I'm going to start with the ones that are most at risk, you may want to think about ones that have multiple shareholders. And then second is with retirement plans. Miscalculated reasonable compensation figure can put the retirement plan at risk, and the penalties for that are will make other penalties look insignificant. And this is from the IRS guidelines on that topic that state a reasonable compensation issue that includes an adjustment of a pension and profit sharing deduction requires a referral to employee plans. So again, if you haven't been advising your clients on reasonable compensation, you're taking this course because you're ready to, this is the year I'm finally going to do it, and you're prioritizing your list. If you have ones with retirement plans or multiple shareholders, those should rise to the top of your list and start looking down that. And we'll share a quick tip from your colleague. I had mentioned a little earlier, those of you that had rated yourself high on the experience level with S Corps, if you wanted to share with us, we'd appreciate it. This came in last year from Lucia, and I said we generally see reasonable comp move to right about the Social Security max in a challenge. Well, last year it went far beyond that for her client, and they went up to $250,000 because there is something to go for now above the Social Security maximum. There's that extra Medicare tax. Surviving a reasonable compensation challenge, there's really only two ways to look at this, and it depends whether you've been proactive or reactive. Of course, we all know being proactive is going to put you in a much stronger position. You're going to go to your file, you're going to pull out the research and documentation, you're going to present it to the examiner, and it's going to shift the burden of proof from your side of the table to their side of the table. We'll take a look at this tip a little later from one of the other experts in the field. In the words of a former IRS examiner and appeals agent, at this point in time, the examiner should see that the taxpayer did their best to come up with a figure, check it off their lead sheet, and move on. And if it's been added to the corporate minutes, there's an extra step in puncturing those corporate minutes. Reactive, you still need to do the research and documentation. As the gentleman from Boston found out last week when he called us, and he went in there and was incredibly frustrated because they wouldn't accept his 50-50 compromise. They wanted to see comparability data. So you go out there, you get your research and documentation, and then you negotiate. And hopefully you have some unbiased data that you can negotiate from. We found that most of the agents that we get feedback on are reasonable, and they'll compromise, and you can come away with a number that is, well, for lack of a better word, reasonable for the services that were provided. And next we're going to move into talking about different methods for determining reasonable compensation. In 2014, internally, the IRS put together a job aid for valuation professionals. Reasonable compensation, job aid for IRS valuation professionals. Now, this job aid was put together by the Large Business and International Division. And it does mention in it that it cannot be cited or relied upon others. You don't want to take this study or this job aid with you into court and say, well, I did it just like it says in here. However, this job aid is a very good resource for audit prep. It talks a lot about the strategies that an examiner may use when challenging reasonable compensation. However, it's not as beneficial for S Corps, or let me rephrase that, for small businesses, as I would have liked to see it, mainly because it was put together by the Large Business and International Division. And as we get into the different methods for determining reasonable compensation, some work better for certain size companies in certain situations. So those of you who may have heard this name, his name is Michael Gregory. He was a long-time IRS employee. He had reached the management level, and he was instrumental in getting this job aid and some other job aids put together. Michael has retired from the IRS. He now specializes in peaceful resolution, but he is the one who filed the Freedom of Information Act that had this job aid released to the public. So we thank Michael for that. He also read a companion book that goes along with this job aid if you'd like some additional clarification or help on the job aid. I've gotten to know Michael pretty good over the last couple of years. He very much is a fan of the cost approach for determining reasonable compensation for small businesses and S Corps, and of RC reports. That is our method. So in this job aid, in addition to a great number of other information, it talks about 3 generally accepted ways for determining reasonable compensation, and we're going to run through them one at a time. And the first one is called the income approach, also known as the independent investors test. I am going to compare these to how one might value real estate, because they're very similar. So the income approach will seek to determine whether a hypothetical investor would be satisfied with their return on investment when looking at the financial performance of the business in conjunction with the compensation level. The income approach can only be used when the fair market value of the business is known. Unfortunately, the fair market value for most small businesses varies significantly year to year and can be challenging and time-consuming to determine. Even if a fair market value for the business can be established, it can be a challenge to determine what an independent investor for a small business would require in a return. Think what a venture capitalist might be looking for versus Uncle Ed. Because of this, the income approach is nearly not that practical for most small businesses. So when you're comparing it to real estate, if you're a real estate investor and you're making an investment and all you care about is how much money you're going to make on that building, you're not comparing it to other buildings in the area. You're only concerned about your return on investment. And that's how this method works as well. And this method I like very much for outliers, and I'll talk more about outliers in a second. Sometimes it's a very important issue and you need to go into court with multiple methods. This isn't a bad backup to support one of the other 2 methods. But I like it most for outliers. And what do I mean when I talk about outliers? I'm usually talking about a business owner who has a very, very unique occupation, skill, or duty. In other words, there is no comparability data for what they do. They are also individuals who achieve phenomenal results that are off the charts. So even if you can find comparability data for what their occupation is, they are so far above their peers in what they do that you really can't equate it. And so in those cases, I like the income approach. So it doesn't take comparability data into consideration. It simply says the business is making Y is worth Y, therefore the CEO, the general manager, deserves to make X. The other reason it's not very practical for most small business owners is the process can take weeks and sometimes months. Usually valuation experts are retained, and a cost for an income approach, reasonable compensation study, is usually somewhere in the $3,000 to $10,000 range. So again, not very practical for most small businesses. The second method we're going to look at is called the market approach. It's also sometimes referred to as the industry comparison approach. And it determines the owner's compensation by looking at the compensation of employees in businesses of similar size and from the same industry. The market approach focuses strongly on the owner's business and the specific position held, and that's generally going to be a manager, such as a CEO or a general manager. The approach then compares both the business and the position to that of its peers, and it draws a conclusion on what the reasonable compensation should be. So if we're comparing it to real estate, it's similar to valuing a house in a tract neighborhood. You take your house, and then you look around your neighborhood at what's sold in the last year, and then you make minor adjustments based on the differences. This house has a 3-car garage, we have a 2. We have a finished basement, they don't, etc. And you work to come up with your reasonable compensation figure. So the market approach works well when only one occupation, and that's generally upper management, is being compared to its peers within the same industry and with companies of similar size. And this method generally works well for medium and large businesses because the comparisons are being done off of financial statements. Small businesses are not required to put their financial statements on file anywhere. So finding a financial statement, or a series of them actually, on a small business within the same area of the same size, where the owners are doing basically the same services, it's difficult to do, it's difficult to find. But medium and large businesses, not so hard. And there's a number of places you can go out to find that data. And here's a few of them: the Economic Research Institute, Risk Management Association. The BLS has some data, and then there's some private industry surveys. Generally speaking, a reasonable compensation study using the market approach is done by either a reasonable compensation expert or a valuation or appraisal expert as part of their overall valuation report. And they can cost somewhere in the neighborhood of $2,000 to $4,000 generally. Again, not all that practical for small businesses, and it's really hard to come up with the data, even if you wanted to use this approach. So that leaves us with our third and final method that we've talked a little bit earlier, called the replacement cost approach, also known as just simply cost approach, or sometimes referred to as many hats. It was used in McAlry by the courts, and of one of the two methods the IRS expert used. And the easiest way to determine which method might be being used, if you see hourly rates used that are multiplied out, that's normally going to be cost, and various job duties discussed, that's going to be cost. If you see annual salaries used and typically just management positions used, you're typically looking at market approach. So if you're comparing the cost approach to real estate, that's valuing a piece of property by simply adding up all of its components. How many 2x4s, shingles, tiles, bricks do I need to build this house? And that's the cost approach. It takes into consideration all the tasks a business owner provides to their company, such as administration, accounting, marketing, purchasing, etc. It breaks the time spent by the owner down into various tasks. Wage levels are assigned based on the owner's proficiency or experience, and then added back together to obtain a hypothetical replacement cost of the owner. This is the most practical for most small business owners, and it's what RC Reports was built to do, and it's the simplest, fastest way to come up with a reasonable compensation report using the cost method. This is what a reasonable compensation report looks like. These are 3 pages of usually a 5 to 7 page report. The tail page on this report also includes corporate minutes, so you can add it into the corporate, some sample corporate minutes, so you can add it in and give it that added layer of defensibility. Now, our software is designed for CPAs and EAs to use when they have a client that needs their reasonable compensation figured out. So we don't deal with small business owners directly. So the cost for this report isn't set by us, it's set by you. But in surveys that we conduct, most advisors charge their clients somewhere in the neighborhood of $250 to $500 for one of these reports. Some of the features we think you'll love about the software is the results are available immediately. The software runs in the cloud, and we're all familiar with hearing that over and over again now. You or your client goes through a short interview process. At the end of that interview process, there's a reasonable compensation figure. The interview and the report are editable for up to 30 days afterward. Just give you and your client some time to go through it, make sure you're on the same page. Since we did build it for your industry, you only need one account, and you can add as many users in your firm as you need to. You get access to our exclusive database of wages, and it's about 3 times larger than you're going to find anyplace else. And some of our users started using it to help with practice development, and they shared some of that information with us. We had an article come out last month, and that's up on our website, and they talk about the relationship building that takes place as you talk to all the different hats that a small business owner wears. And it's really helped some businesses build their practice, and that was an unexpected outcome of our software. It helps them get additional engagements such as retirement and succession planning. If they're providing payroll, they have the opportunity to talk about that with their clients. So if you're interested in that, you can track down that article from our website. But probably more important than anything else is our track record. Our reports are unbiased. They're not designed to give you a high number or low number, but an accurate number based on the services you provide. It's one of the 3 methods mentioned in the IRS jobs report, and probably the most recognized and most practical method for determining reasonable compensation for a small business owner and S Corp owner. And it's what the courts used in McAlry. We've always done a promotion tied to CPA Academy. Matter of fact, we always hear from quite a few folks that attend that one of the reasons they do is because we do the promotion here. But some things you should know about our software, whether you're interested in it today, next month, or next year. First off, we have a number of free tools available to everybody, and in the Q&A I've seen some questions going back and forth about sending out engagement letters or issue letters to your clients to help protect yourself from preparer penalties. We have those in our tools section for you for free. And creating an account or registering with us comes with no cost now or ever in the future. And if you ever want to run a reasonable compensation report, you can run them on a pay-as-you-go basis, and they're $199 each. We have 2 annual subscriptions. One's a basic and one's a premium. They come with unlimited clients, unlimited reports, either 2 or 3 seats. And you can run as many reports as you want for as many clients as you want over the course of the year. And we have a money-back guarantee. Try us out, use us. If it's not what you thought it would be, if you're having issues, call us. If we can't figure it out, make it right, we'll refund your money. We have exceptional customer service, and knock on wood, to date, we've had nobody take us back on that money-back guarantee. Firms that use our software more than 2 times in a year, which is very little, renew with us. 93% of them renew with us. That's unheard of in the industry, and we very much appreciate that. But we also treat our customers like we like to be treated. If you had used our software and you came up on your renewal and you hadn't used it as much as you thought, very little, we always offer an additional 6 months at no charge on your time frame when you're ready. Our philosophy here is we're going to treat you as we want to be treated. If you want to take advantage of our promotion, when you have an account with us, you go into the subscription area. There's a promo field. You can enter the code PURPLE. It'll discount our premium service, which has some great additional tools, especially our quick wage lookup. You can look up one wage real fast. Branding reports with your firm name and logo instead of ours, and a number of others, and you can get that for the same price as basic. But more importantly, when comes time to renew, we carry this discount forward. And that's a personal pet peeve of mine. Cable companies do it all the time. Here's your introductory rate. It's going to be more next year. With this particular code, it won't be. You'll always receive the same discount. So we hope that those of you that are ready to subscribe will take advantage of this promotion. If you're not, there's a couple other things that you can be thinking about if you are interested. One, CPA Academy has a self-study course. It's a full demo of RC reports. You can take that and see how it works. We also offer a non-credit live demo, and those will start a little later this month, and we run 2 a month through the middle of January. And you can pop on one of those and see the software in action. And we're going to wrap up with some tips from the experts, and then we're going to turn it over to Jack for Q&A. First and foremost, when you're talking with your clients about reasonable compensation, please realize that it might be a sensitive issue with them. But if you talk with them about the concept of reasonable compensation, that it's their replacement cost or fair market value, that it's not their worth as a human being, nor does it include enterprise goodwill, net worth, business profits, etc. If you're successful in pulling the ego out of the reasonable compensation figure, you'll get a much more accurate number. Keep in mind that reasonable compensation, as defined by valuation experts, is the hypothetical replacement cost of an owner or key manager. Now I'm going to share with you some tips from some of our friends in the industry. These are fantastic individuals, experts in the field of reasonable compensation, and the first is Stephen Kirkland. He's one of 2 people. If you have a serious reasonable comp issue and you need a market study, an income study, an expert witness on the issue, Stephen's the first name that's going to pop in my head and I'm going to send you to. And these are some of his tips. On your software, it will tend to carry answers from one year to the next. And some of these answers are just simply overlooked. But if you're wearing many hats for your business and you have in your occupation, you can put down various or many hats. That's one of Stephen's tips. If you're doing Form 1125E and you're not devoting all your time to the business, put down how much time you are involved. This is a great one for the spouse that's not really providing any service. Put down 0%. Wouldn't it be fantastic if a challenge came and you were able to pull this out and say, look, we told you she was an officer in name only. And then Stephen recommends that you check your NAICS or SIC code because different ratios are used by industry. When throwing IRS red flags, again, it doesn't mean that you paid yourself unreasonably low compensation, but why throw a red flag unnecessarily? And my favorite quote from Stephen, an opinion has value if it is supported and can be defended. The next tip comes from Dennis Tafalski, a retired agent, 31 years as an examiner and appeals agent, and he consulted with RC reports early on, and he is the reason our S Corp report includes sample corporate minutes. One of the first things an examiner does is ask for the corporate minute book, typically. If the examiner sees that the taxpayer took the time to best determine what their comp should be, examiners should indicate it on their lead sheet and move on. The burden of proof has now been shifted from the taxpayer back to the IRS side of the table, and if it's part of your corporate minutes, you've added an added layer of defensibility. Great tip from Dennis. And finally, buy the book, Reasonable Compensation by Ron Sr. and Kevin Yiannopoulos. Ron is here in Denver. I would also recommend Ron if you have a serious reasonable compensation issue. And I think one of the things Ron also specializes in marital disputes when reasonable comp comes up. I'd highly recommend him. Ron and Kevin are putting together their second edition of the book, and we're very honored to have RC reports added in there as a resource. And with that, I'm going to share with you my contact information and Jack's contact information. You're welcome to reach out to us if you have questions from today's webinar or experiences you'd like us to share with your colleagues or just a reasonable compensation issue that came up. I got the call last week from the gentleman out of Boston. He had taken our class quite a while ago, but he had taken it. For some reason, we didn't get the 50-50 rule through to him, but I tried again when I talked to him the other day. And here in just a second, I'm going to turn it over to Jack. He's going to talk about questions he's seen today and other questions he gets regularly at RC reports. And with that, Jack, if you're there, please chime in, and I'm going to take a look at see if there's any questions I can answer on the Q&A panel.
Thank you, Paul, and I hope everybody has enjoyed this class. I know Paul and I both enjoyed giving it. And a lot of times when a question comes in, there's more detail for an appropriate answer than can be given in a one-line answer. When that happens, I typically will put in to contact me. Again, the contact information is up on the screen. Please do. That way we can address the issue in entirety. When you leave your name and number, also leave the best time of day or days to contact you in the time zone you're in. We're in the Mountain Time Zone, but I don't mind calling people on the East Coast what would be relatively early. It actually helps in my schedule, and the same with the West Coast. Also, a lot of times, I know when I'm taking a class, I will think of questions after the fact, either driving home or waking up in the middle of the night. Don't hesitate to reach out to us. That's what we're here for. And so let's get into some of the questions that came up that I said that I had tried to address in the Q&A. The issue of preparer penalties must have really hit a nerve with a lot of people today. A number of people wanted more detail on that. And what the cases were, the first one was a gentleman in Northern California. He had taken on a client who had unreasonably low compensation. It was extremely unreasonably low, in his words. And once he retained the client, or the client retained him, he started tweaking the wages up. And so he was trying to avoid red flags by getting the wages too high too fast. They got audited. IRS assessed him a $5,000 preparer penalty because when the IRS came in, the wages were just a little bit unreasonable, but when looking back 3 years, they were a lot unreasonable. So he got assessed the penalty. He eventually did beat it, but what he indicated was that the service made his life a living hell. He felt that they had destroyed his reputation in a small community. And so it was his practice to do reasonable comp assessments on virtually every S Corp client that he has, because he just did not want to go through it another time. And so the big takeaway there is, if you have a client that does have egregious unreasonable compensation, to get them up to being reasonable as fast as possible, preferably in 1 year, but you know, you have to use your professional judgment in that. And so that was the first case. The second case was a lady in Colorado Springs that her client just refused to pay what they should pay. IRS auditor client assessed her a $4,000 reasonable comp, or not reasonable comp, a preparer penalty, because she hadn't let the client continue to do unreasonably low wages. And so it's happening. It's low-hanging fruit for the service. We got to document what we're doing, why we're doing, and with those types of penalties, if a client is not willing to pay themselves what would be considered reasonable, you know, I think we need to do some serious thinking about whether we want them as a client. $4,000 or $5,000 is a lot of preparer penalties to try to avoid, not to mention the energy and the heartache of trying to get it all squared away. So, you know, document, have the client document, and try to get them around. And part of that also goes to, clients. A lot of clients are going to be thinking they want to keep compensation low to avoid payroll taxes. They're not looking on the effects of that long term. And those effects could be, reduced Social Security, reduced disability income if they are unfortunate and have to go on disability, reduced compensation to retirement plans. So those are all things that we need to make the client aware of so that they know that there are consequences to having unreasonably low compensation that could come back and hurt them. Because when those things do happen in their lives, and they will happen in some of our clients' lives, undoubtedly, they're going to be looking at us as the trusted advisor saying, why didn't you tell me this? And so we also need to document in our files those conversations. One of the things that's come up a number of times just recently is, does the IRS ever raise an issue of getting too high a compensation? And the IRS does, and the state income tax revenue departments do also. And where the IRS claims that compensation is too high is when it's obvious that the person is doing the high compensation to enhance retirement contributions. And that can definitely be an issue. The other issue that we've seen come up a couple times in individual states, is businesses in one state, client as an individual is in another state, W-2s get assessed in one, the distributions or the profits get assessed in the state location. The states start to say that the wages could be too high because they're not getting taxed enough on the distributions, or the distributions may be entirely tax-free. Or in one person today said in Tennessee, the distributions are taxable, but the W-2s and the K-1s are not. That's also a case where Tennessee could argue that your wages are too high and you have unreasonably low distributions. So, we have to look at it from all angles. Usually when the IRS raises the issue of too high of compensations, it's related to C Corps. The concept of reasonable comp is the same whether it's an S Corp or a C Corp. But with C Corps, most of our clients want to have the wages high so they don't have to pay dividends. And so the IRS tries to reclassify those wages back to distributions. Now in the jobs report, there is a section in there that talks about if your taxpayer is paying themselves too high of wages, if it's to make up for prior years, that's okay. They can do that. That's justification for having unreasonably high wages. And that same concept should hold true in an S Corp too. But the jobs report also states that if the taxpayer is going to make that argument, they need to be able to prove out how they came up with the amount of wages that were a shortfall in prior years. And it has to be documented proactively. If a corporation gets audited and you try to do it after the fact, you're going to get no headway at all. So there again, documentation. If you go on our website, the information is there to go back 10 years so that you could come up with the shortfall of wages for that period of time, put that in the minutes, and then you should be golden as far as having a little bit higher wages than what is normally appropriate. Just about out of time, so I'm going to go real quickly here as an idea for using this whole concept, and that's entity planning. A lot of clients, if they're Schedule C filers or LLCs, they would be better off being S Corps. How do you determine that? Basically by doing some research. What's the difference between paying self-employment tax on their earnings versus employment taxes on wages? And is that savings greater than the cost of preparing a tax return, an extra tax return, if they're an S Corp, or if they're a Schedule C, rather, I'm sorry. And if it is, it makes sense to change the type of entity. By doing that, you also look like a real hero to your clients. It builds incredible loyalty because you're looking out for them. The other thing that happens is the people that are the most receptive to looking at what reasonable comp is or should be is the new corporate entities. It's one of the first questions that gets asked routinely. So it's something that we should be looking at because we all have clients that are Schedule Cs that could save themselves a fair amount of money by being an S Corp and following the rules, even with taking into account the extra cost of administering another entity. With that, we are out of time. So again, if there's any other questions, reach out to us. We'll get back to you as quickly as possible. Thank you.
All right. Well, Jack, thank you so much, and Paul as well. Fantastic job as always. Jam-packed full of information. I appreciate you taking us right up to the end with a whole lot of great details here. So, seeing a lot of great comments coming in as well. We'll have a hard time reading them all out, but just a ton of questions, and we'll pass those along. Obviously, see contact information for our presenters right there if you do have questions that come up following today's session. We'll get to work on issuing credit for everyone. Again, you'll see an email from the CPA Academy. We also, as you may be aware, have an on-demand version of this course for your colleagues who perhaps have not taken it. They're more than welcome to do so, as well as earn credit. A copy of all those handouts will also remain available to you, so if you didn't grab them ahead of time and you would like to, certainly do encourage you to do so, as well as Paul made a great offer to our members, so I encourage you to take advantage of that. So, comments coming in, fantastic webinar, great session, great information, terrific presentation. So I really like seeing those. Thank you to everyone who typed in. And again, Jack, Paul, thank you both so much, and looking forward to the next one with you.
Thank you very much, Matt and Jack, for answering all those questions. One quick question came in at the end. I'll answer real quick. Do we ever do this presentation live? Yeah, we do, and it's a lot of fun to do live. We only tend to do it here locally for obvious reasons. But if this is ever an issue with your group, tax group, society, etc., reach out to us depending on specifics, timing, etc. We actually have a ball doing this one live. So if we have a chance to catch up with you live at some point in time, fantastic. Other than that, we're finished up. Go get lunch, breakfast, dinner, whatever your time zone is, and please reach out to us with any questions. Take care, everybody.